Welcome one and all to our final plenary session of the 2021 EFMA conference. I hope that you have all enjoyed the sessions so far as much as I have. While this is the last plenary session, we are finishing on a real high. It is my great honour to welcome Professor Jay Ritter to deliver our keynote address on the subject of special purpose acquisition companies. Jay has served as the Joseph Cordell Eminent Scholar in the Eugene Brigham Department of Finance at the University of Florida's Warrington College of Business since 1996. He is a world-renowned expert on equity issuance, has published absolutely key articles in the field, and has been writing in this area for almost 4 decades. And sadly, as I was saying to Jay before other people joined us, sadly, only because of my age, I have been reading his work for that long and being inspired by what he has had to say. His articles have won several Best Paper Awards, including at the Journal of Finance, the Journal of Financial and Quantitative Analysis, and the Journal of Financial Economics. Jay has served as a director of the American Finance Association and as president of the Financial Management Association. He's also been an associate editor of numerous academic journals and is frequently cited in the financial press. Jay is going to speak to us on SPACs, and at the end of his talk, we will have some time for questions, and Jay is happy to take questions as we go along, and we'll stop at certain points to give you the opportunity to ask questions. Please use the chat function if you have any questions. When we finish this session, we will announce some awards and say thank you to some key people. I do hope that you can all stay for that part of the conference. But for now, it is my great pleasure to hand over to Jay. Thank you, Jay.
SPACs are special purpose acquisition companies. This presentation is based upon a paper that's co-authored with Minmu Gong of the University of Florida and Dongheng Zhang of the University of South Carolina, who is a Florida graduate. SPACs have been around for a couple of decades, but in the last year, they've gotten a huge amount of attention. There's been a booming market in the United States. 2019 saw 59 SPACs go public. Last year, that quadrupled to 248. And in the first 3 months of this year, 298 SPACs went public, an annualized rate of 1,200, just enormous growth. The last couple of months, it's slowed down quite a bit. But we've still seen a record number and a record amount of money raised. And with all this activity in the market, it's gotten a lot of attention from regulators, financial journalists, and there's a lot of controversy about SPACs. There's a good reason that there's a lot of controversy. They're complicated, there are costs and benefits. Our paper is analyzing some of those costs and benefits. When a SPAC goes public, it usually has a unit structure. And in the US, they almost always choose a $10 per unit IPO price, where the unit is composed of a share of stock and typically a warrant to buy a fraction of a share. So for $10, you're buying a share and you get a warrant tossed in that gives you additional upside potential. Now, with a normal IPO, you're buying shares in an operating company, a business that has some service or product that it's selling or hoping to sell. With a SPAC, they just take the money and put it into a trust and then go look for a company to buy. So the SPAC itself has no operations. It's just looking for a company to merge with and then become that operating company. For the money raised in the IPO, it's put into a trust fund with a third party. And then the middlemen, the sponsors who created the SPAC, spend their time looking for a company to merge with. And after they identify a company and negotiate a merger, they then announce this. And the shareholders of the SPAC have to vote on whether to approve the merger or not. And they also have the right to ask for their money back. The money that's sitting in the trust fund is collecting interest, and the shareholders both vote for or against the merger. And whether they vote for or against the merger, each individual shareholder also has the right to ask for their money back. So because you can get your money back, there's no downside risk. There's only upside potential. It's like a default-free convertible bond, but it's even better than that because you've also got the upside from a warrant. So not only do you have the right to keep your share if you think the merger is going to do well, but you also have a warrant that adds additional value. And this warrant almost always has a maturity date 5 years after the date of the merger. But if there's no merger, you get your money back, but the warrant expires worthless. So for the SPAC unit holders, they've got an incentive to vote in favor of the merger, even if they don't think it's good, and ask for their money back because the warrant would still be worth something. Whereas if there's no merger, the warrant becomes worthless. And typically 2 months after the IPO, the shares and the warrants start trading separately. So you can sell the shares, you can sell the warrants, but whoever owns the shares has this redemption right. So that travels with the shares. It's not restricted to just whoever bought it at the time of the IPO. So the typical timeline for a SPAC is it might take 2 months for the sponsor to put the SPAC together and get SEC approval to do the deal. They take it public, providing they can get buyers to buy it at the IPO price. Then they search for a merger partner. And if there's a deadline, typically 18 months or 2 years to complete a merger. And if no merger has been completed by then, the shareholders get their money back, or the sponsor could ask for an extension to give some additional time. But if they vote for an extension, the shareholders still have the right to get their money back at that time. So investors have a lot of protections. Now, a SPAC IPO, just like other IPOs, isn't free. There are underwriter fees, which almost always are 5.5% of the proceeds. And usually the underwriters take 2% of that up front and defer the other 3.5% until the time of a merger. So the unit is sold for $10. 20 cents of that goes to the underwriters right away, and that leaves $9.80 to be put into the trust fund. But in practice, what happens is the sponsor at the time of the IPO buys warrants and pays a fair market price for the warrants. And on a typical deal, which might be $200 million, the sponsor might buy $7 million worth of warrants. 4 million of that would be 20 cents per share, which tops up the amount put into the trust fund. So $10 is put into the trust fund rather than just the $9.80 in net proceeds. And the other $3 million or so is there to cover the expenses of searching and then negotiating a merger partner. So the sponsor has to put in some money up front, and they're going to lose all of that if there's no merger. What do they get in return? Well, they've got the warrants, but they also give themselves 20% of the shares. So the SPAC might sell 20 million shares to raise $200 million, but the sponsor also gives itself 5 million shares for virtually free. So there are 25 million shares outstanding. The amount of cash per share is only $8, but the sponsor doesn't have the right to get any of that trust fund amount. Only the public shareholders get that. So in fact, there is $10 per public share available sitting there. So basically, there are two periods for the SPAC life cycle. You've got that SPAC period from the IPO until a merger or liquidation. And then you've got the post-merger company. And that's known as the de-SPAC period. It's no longer a SPAC. It's an operating company that merged with the SPAC. The SPAC changes its name to that of the operating company and has some shares in the operating company. But basically, the shareholders own stock in this operating company after the merger. And if the operating company does well, the stock will go up. If the operating company is a disappointment, the stock price will go down. And after the merger, there's no longer any redemption feature. The warrants are still there, however, so there is that potential additional upside. But if no merger occurs, the SPAC gets liquidated, the sponsor loses everything. If the company does well after the merger, not only are the sponsor warrants worth more, but they've also given themselves 5 million shares, which if the shares are worth $10 each, that's $50 million worth of shares. So the sponsor puts in $7 million up front and gives itself shares worth $50 million. This is a great deal for the sponsor. This is why there's been no problem at all finding lots of sponsors who want to create a SPAC and take it public. Phil, are there any questions at this point?
Sorry, yeah, just two questions. With the SPAC, so who's paying the underwriter there? And while I can see the advantage for sponsors, what's the advantage given that these huge amounts of money? What is the advantage in terms of investors? Why would people be willing to get involved in these, given that the sponsors seem to be taking a very large chunk of the money?
Yeah, well, the sponsor pays those upfront underwriting fees. But if there is a merger, the remaining fees get paid by all of the shareholders. You're raising a great question in terms of, with the sponsor getting all of this, what's in it for those public market investors? Well, for the IPO investors, as I mentioned before, they're essentially getting a default-free convertible bond. Where there's that upside potential. And this is a great deal for the IPO investors. But the sponsor does have to come up with a merger with a good company and negotiate merger terms that are attractive enough to make it worthwhile for the SPAC shareholders. After all, there's only going to be $8 in cash for the merger, and if the share price is at 10, some value has to be created to come up with that other $2 per share. there's got to be some net present value there. But there definitely are conflicts of interest between the three main players: the operating company that the SPAC is merging with, the sponsors, the middlemen, and the investors, the public market investors. And you're creating a pie that has potentially some value. But there's also an issue of how the pie gets divided among these different constituents. And there are agency issues. What's best for the sponsor might not necessarily be best for the public shareholders. Just like with a normal IPO, what's best for the underwriter isn't necessarily what's best for the issuing company. There are trade-offs here where, presumably the market tries to come up with financial contracts that limit some of the agency problems to create a financial structure that does not create incentives to destroy value, but creates incentives to create value.
Jay, we'll have another question in the chat.
Sure.
Who is covering the warranty if anything goes wrong?
Well, for the trust account, that's a third party, normally a well-known commercial bank. And to date, there have not been any fraud cases where the money got stolen or anything. There's the possibility that might occur in the future, but to date, that has not been a problem. Now, this was not always the case. 40 years ago in the US, there were blank check IPOs where there was a fair amount of fraud. But typically they were for only a couple of $1 million, and sleazy characters were frequently involved. Canada has capital pool companies, which typically also raise only a couple of $1 million. But Canada regulators put in some checks and balances, regulated them. And the US in 1990 passed a law putting some restrictions on these so-called blank check companies. And the SEC came up with their Rule 419, which mandated that there be a independent trust account with a third party managing it, and put in some other checks and balances, such as majority voting or supermajority voting to approve a merger where the SPAC sponsor shares aren't allowed to vote on that. So there's actually a dual class stock structure, but where the insider shares actually have inferior voting rights. They're not allowed to touch the trust money. They're not allowed to vote on the merger. Now, this has largely been a US phenomena. In the UK, to date, there's been a problem that UK merger law mandates that when a merger is announced, there's got to be a trading halt in the stock. And that creates a problem when you've got a SPAC announcing a merger. If the stock stops trading, what can you do? There are proposals, as I understand it, to change that. But in Asia, there have been some SPACs. In Europe, there have been some SPACs. But to date, it's mainly been a US phenomena. But it is getting attention all around the world. Okay. Well, let's think about these contractual terms. We've got deadlines. Deadlines have costs and benefits. Why are there deadlines? Well, if we think about a private equity contract or a venture capital contract with limited partners, the general partner typically puts in deadlines where there might be a 5-year investment period where the limited partners are committing capital, and the general partner has to invest that within 5 years and then return the payoffs from the investments to the limited partners within 10 years. Why do you have these deadlines? Well, for the limited partners, otherwise there's illiquidity. Same thing with the SPACs. If the sponsor could keep the money for a long time, the investors have put their money into a trust fund, and this is illiquid. So by putting a deadline there, you've got better liquidity. But solving that agency problem creates a new agency problem. As the deadline approaches, the general partners or the SPAC sponsors have an incentive to spend the money to do a deal, even if it's not a great deal, as long as there's variance, since the general partners in venture capital get their upside carry, they might have an incentive to invest in a negative NPV investment as the deadline approaches, because they get the upside and the LPs get the downside. Or they share the upside. Same thing with the SPAC. If the deadline approaches and there's no deal, the sponsor loses everything. So they've got an incentive to possibly invest in a bad deal. But that's where merger approval is required. And that's where the redemption option comes in as well. With that redemption option, the shareholders can vote to approve the merger. But if they all ask for their money back, how can the sponsor complete the deal where they have no cash to deliver to the operating company? And the operating company in negotiating the merger is going to require that a certain amount of cash gets delivered. So, deadlines solve one agency problem, but they create another agency problem. But that's where the separation of the voting and the redemption can deal with that second agency problem. Phil, are there any other questions at this point?
Yeah, just is the boom in SPACs because it's a cheaper way to go public than a traditional IPO? How do those costs compare is the question.
Well, because of this SPAC sponsor promote, as it's called, and the underwriting fees, SPACs are not costless, but IPOs aren't costless either. You've got money on the table and underwriter fees there as well. And if you look at the numbers, and we've done that in this table, for SPACs, if we look at the median, the costs as a percentage of the proceeds, the cash delivered to the company, the total costs are like 48% of the cash delivered. That's enormous. The costs as a percentage of the market cap of the merged company, a median of 15%. What about with traditional IPOs? Well, they're not cheap, but the median is about 22% for costs to cash delivered, net proceeds, and about 3% for costs as a percentage of market cap. So the SPACs are much, much more costly. A direct listing is even cheaper, where the company goes public by just listing the shares without doing a formal IPO. And this raises the question, if SPACs are so expensive, why does anybody use it? Why would an operating company merge with a SPAC rather than doing a traditional IPO? And this is one of the things that critics have focused on, that SPACs are a really expensive way for a company to go public. Well, as financial economists, financial contracting theory involves thinking about, well, what are some of the covariance properties that might make something that on average is expensive still an optimal way of doing things, at least for some companies. And that's what we do in this paper. We ask, given how high these costs are, what could be some of the advantages of using a SPAC that for at least some companies make it attractive? Well, one thing that the previous literature has also noted is these sponsors are kind of the equivalent of general partners of a private equity firm or a venture capital firm in certain respects. You know, with venture capital and private equity, the PE firm, they get their 2 and 20, their 2% management fee per year and their 20% carry. And, you know, on average, this eats up about 20% of the money that the limited partners provide. Yeah, you know, so the middlemen are getting a lot, but presumably they're providing some value in return for getting their cut of the action. And presumably with sponsors of SPACs, some of that goes on as well. There's a lot of heterogeneity among SPAC sponsors. Recently, some of them are famous athletes or celebrities, but more typical, you've got somebody with industry expertise, an auto industry executive of a big auto company might start a SPAC that's aimed at merging with a startup electric vehicle company in the auto space. So you tend to get most SPACs focusing on merging in a specific industry or geographical area where they're using the expertise of the sponsors. You don't see auto industry executives creating a SPAC and saying, well, we're going to merge with a company in the food delivery industry. Instead, you get specialization, just like venture capitalists specialize in the industries that they're most familiar with. Also, the SPAC has raised this money in advance, and it might be a faster way for a company to go public. And by negotiating the terms up front, there might be less uncertainty for the issuing company about what the terms of the deal are going to be. When you go public, it might take 6 months to go public, and who knows what market conditions are going to be like 6 months from now. The deal might never occur. The IPO might raise a lot less money than expected. There's a lot of uncertainty there. And with a SPAC merger, you can negotiate upfront. Now, there's still some uncertainty about how many shareholders will redeem and other things going on, but there might be less uncertainty than with a traditional IPO. Well, if we think about the relative advantages of merging with a SPAC, you've got that capital. You've got some extra financial value. It might be faster. We're about to post an updated version of our paper where we've calculated the length of time it takes from the announcement of a merger to the completion of the merger. And on average, that takes about 141 days, almost 5 months. And before that, you've got the merger negotiation. So, you know, it might take 6 months on average, which is about the same time as for many IPOs. So while the conventional wisdom is that a SPAC merger might be faster, when we look at the evidence isn't so clear-cut on that. For some companies, it might be faster. For other companies, it might not. Another thing that has been raised for why a SPAC merger is more attractive is what's sometimes called regulatory arbitrage. And this is more specific to the US. But in the US, when a company goes public, it's a securities offering and is subject to security offering laws and potential lawsuits. To date, SPAC mergers have been regulated as mergers. And mergers don't require audited financial statements from the private company. And for a company that doesn't have audited financial statements, merging with a SPAC might be an easier way and faster way of going public. Recently, the SEC has raised questions about whether there is a regulatory arbitrage or not, however. A couple of months ago, the SEC pointed out, we don't define initial public offering. These SPAC mergers involve an operating company listing and raising money. It looks an awful lot like an IPO. Maybe we should be regulating these as securities offerings, not as mergers. The regulatory arbitrage might be changing. Phil, are there any questions at this point?
Yeah. When my face pops up, I'm about to ask a question, Jay. Okay. I have a question. How successful are SPACs compared to traditional IPOs? And I have another one, which is what happens if a merger is announced, but the market isn't enthusiastic?
Well, it is the case that sometimes the stock price drops on the announcement date. Although in the last year, typically there's been a positive announcement effect. And in the past, there's typically been a positive announcement effect as well. But if the market is not enthusiastic, what happens is that you get a lot of redemptions. Basically, each shareholder is looking at the trust fund and saying, okay, $10 was invested with interest. It might now be $10.05. Is the market price of the stock higher than $10.05? Well, then I don't want to redeem. Instead, I want to keep my share or sell the share for more than that. But if the market doesn't think it's a very good merger and the stock price is no higher than $10.05, I'm just going to redeem. And that creates a problem for the sponsor because all of the shareholders are making the same decision. They're looking at the market price. They're all seeing the same number. They're all deciding to sell or to not sell, to redeem. And so you get situations where 99% of the shareholders redeem, and the SPAC, instead of having $200 million, suddenly only has $2 million. And the deal might collapse then. So this does incentivize the sponsor to either renegotiate the deal or negotiate better terms in the first place. And one thing they can do, this slide shows that we've looked at the 145 mergers that have occurred in the last 6+ years. And about half the time you get very little redemptions, almost no redemptions. And about half the time you get really high redemptions, sometimes 50, 60, 70, but it's not at all unusual to have 90 or 99% redemptions. Well, what happens then? Well, sometimes the sponsor says, look, I want this deal to be completed. Maybe I'm being too greedy. I've got 5 million shares that it's diluting the other shareholders. What if I give up some of my shares? That's going to be a wealth transfer to other parties, and that might salvage the deal. Sometimes even the underwriters agree to forfeit some of their fees that are still owed, in that if the deal doesn't get completed, they're not going to get any of that 3.5% commission. And so the middlemen sometimes give up some of their stake. They take a haircut. And this is a covariance situation. On a strong deal, the middlemen share in the gains. On a weak deal, they might give up some of their middleman's take and give a bigger slice of the pie to other parties to help salvage the deal. Well,
can I just ask Oh, I was just going to ask a question about returns. We've got one here. So investors buy the SPAC IPO and decide whether or not to redeem their shares once a merger is announced. What kind of returns do investors get? Perhaps
well, I mentioned before that for the IPO investors, they're getting this default-free convertible bond. On average, over the last decade, the annualized return has been 12.0% for these IPO investors with no downside risk. There wasn't a single deal where they lost money. Even on the deals that wound up in liquidation, they still got their money back with interest. And so 12% per year isn't a huge number, but with no downside risk, this is actually very attractive. And as a result, it hasn't been too surprising that it hasn't been that difficult to find IPO investors. Indeed, until recently, almost all of the investors were hedge funds. They realized that this is a really great deal. There's a free lunch that's been sitting there. And so, unlike sleazy blind check offerings being sold to unsophisticated retail investors, the main buyers of SPAC IPOs have been hedge funds. Now, many of them cash out at the time of a merger, but they're paying attention. And they also put some discipline on the sponsors. If the sponsor realizes they're going to redeem their shares, I better find a good merger, a good operating company to merge with and negotiate good deal terms.
Jay, we've got I think it's a comment more than a question, but it says, somebody's saying that looks too good to be true. Now, I know from my point of view, with my children growing up, when they were growing up, I said to them, if something looks too good to be true, it probably is too good to be true. So we have a comment here that looks too good to be true. Do you have any view on that?
Well, actually, it has been really good and it has been true, but the market has responded. As I mentioned at the beginning, the typical SPAC was offering a share plus a fraction of a warrant, or a warrant to buy a fraction of a share. And that fraction might be one. You get the right to buy another share at an exercise price, or half a share, or a quarter of a share. Well, last year, or the last couple of years, as more and more investors were figuring out what a great deal this was, the sponsors responded by saying, well, look, if this is such a great deal for the investors, we don't have to give them a warrant to buy a full share or even a half a share. And there's been a downtrend where in recent months, the typical deal has only given investors the right to buy a quarter of a share or a third of a share. So the free lunch isn't as much of a free lunch as it used to be. And there's also a concern among investors that there have been too many SPACs, and they're all competing to buy a lot of the same companies. And that's going to make it harder to find a good merger. So supply and demand hasn't been very well balanced. There's been too big a supply recently. And that's resulted in a reduction in the last couple of months in the number of SPAC IPOs. The market keeps adjusting, moving towards a more sustainable equilibrium. Going back to that 12% number, when a merger has been completed, the average annualized return has been 12.9%. When it's been liquidated, the average annualized return has only been 2%. And the average return has been 12%. Now, that's the historical numbers. What about on a point forward basis? Just as I mentioned, there was a free lunch, but the terms have adjusted. I don't think the returns are going to be anywhere near as high in the future for the two reasons I mentioned. One is the warrant isn't as generous as it used to be. And secondly, with so many SPACs looking for merger partners, my prediction is of the hundreds and hundreds of SPACs that are currently out there searching for a merger partner, my bet is that 1/3 of them are going to wind up never finding a merger partner, and the investors are going to liquidate the SPAC and get their money back with, a really low interest rate return. So maybe it'll take 2 years and they'll get a total of 1%, which would be 0.5% per year annualized. And maybe 1/3 of the IPOs will complete a deal, but the shares will be redeemed and the warrants will still be worth something, but not a whole lot. And my guess is it might wind up with an annualized return on those deals of maybe 4%. And then maybe 1/3 of them will find an attractive merger where the shares won't be redeemed. The shares will be worth more than $10. The warrants will be worth more. And, that might give a higher annualized return. And if we take a weighted average of these things, my guess is if you're buying a SPAC now, the expected annualized return is only going to be about 4% per year on a point forward basis if you buy the IPO. So I do think those historical returns have been too good to continue. And on a point forward basis, 4% per year with no downside risk, might sound, but with some illiquidity involved, might be a legitimate sustainable equilibrium. Now 4% with no downside risk is still pretty good, but there is some illiquidity risk. You get your money back at redemption, but you can't redeem whenever you want. You can only redeem at the end if that deadline is hit, or after a merger has been announced. But before a merger is announced, the market price might go up, the market price might go down. A year ago, March, in the COVID panic, when stock markets dropped, a lot of these SPACs dropped from $10 a share to $9.50. So if you wanted to sell then, you sold at a loss. Same thing happened 13 years ago in the global financial crisis in 2008, where prices dropped. And even though you got your money back in the end, if you wanted to get out in the autumn of 2008, you sold at a loss. And so investors need to be compensated for that illiquidity risk. Okay, now what about the de-SPAC period, the post-merger returns? There are papers that had been written roughly a decade ago looking at SPACs from the early 2000s, and they found really bad returns on average during the de-SPAC period. We're finding really bad returns during the de-SPAC period for mergers over the last decade as well. On average, the 1-year buy and hold return from the merger to a year later has been -7%. And that's during a period when the stock market has been going up. So the market adjusted return has been more like -20% on an equally weighted basis. Pretty bad. But the numbers might not actually be quite that bad, because you can predict to some degree which mergers are going to do really badly. In particular, those where almost everybody redeems are the mergers that typically do really badly. Why would the operating company still go ahead with the merger even if not much cash is delivered. Well, they're desperate. So you've got this signal that the company is desperate. They want to go public. This is not going to end well. And almost all the time, it doesn't end well. It's not at all uncommon for the stock to drop by 90% in 1 year. But SPAC investors lose very little money because they redeem their shares. So, they get minus 90% returns when they only had $4 million there, and they get 0% returns on average when they've got $200 million there. And so if you take a cash weighted number, the average return has actually been plus 2.7%, still a little bit below the market, still not great, but not as bad as on an equally weighted basis. The warrants, on the other hand, have a very wide distribution of returns, but on average, the warrants have done great. On an equally weighted basis, they've given an average return in that first year of 64%. So the average stock has gone down, but the average warrant has gone up. That's because a couple of warrants were really big winners. Or on a cash weighted basis, plus 27%, but that's still way ahead of the market. So the warrants on average have done a lot better, but not as much money is involved with the warrants as with the stock. So you can't just take a 50-50 weight on these things. And on average, the whole unit has still been a bit disappointing, but not as bad as used to be the case. So, the market learns. Do we have any other questions at this point?
Sorry, yes, we do have one. Is the 20% promote still standard, just like the 20% carry for venture capital and buyouts?
Yes. With PE funds and venture capital, they get their 20% carry. The SPAC promote is 20%, and that hasn't been changing. But if you read the fine print, there have been changes, just like with venture capital contracts. When you read the fine print, there's actually quite a bit of variation across deals. And what's been happening with SPACs is the sponsor shares typically have lockup periods, which the public shareholders don't at the time of a merger. So if the SPAC merger does really badly, the sponsors weren't able to sell their shares before the stock price dropped. And increasingly, there are vesting provisions at the time of a merger. The operating company might negotiate that the sponsor shares, some of them go to the sponsor if and only if the stock price hits certain targets. So the sponsor might own 5 million shares, but they might be able to keep them only if the stock price is above $12 or only above $15. So they might have 1 million shares that they can sell after the lockup ends, but the other shares they can't sell unless the stock price has gone up. So in that regard, when you read the fine print, it's not quite as lucrative for the sponsors as it appears when you don't read the fine print. And some of this stuff is negotiated at the time of the IPO, and some of it is negotiated at the time of a merger, where if the merger does really well, the shares vest, the sponsor is going to do really well. But if the stock doesn't do well, the sponsor loses some of its shares and gets a smaller share of the pie, giving more of the pie to the other investors. So you've got that covariance property going in there, which you don't see with traditional IPOs. Okay, so the evolution of the SPAC market has been going on, where sponsors in the past have gotten a real good deal. The IPO investors have gotten a real good deal, but these things are changing, which allows better opportunities for the operating company, and that might reflect supply and demand. There's so many SPACs trying to merge with operating companies that the operating companies have more bargaining power now. And the market learns. It's also the case that at the time of a merger, it's very common for the sponsor to bring in a PIPE investor, private investment in public equity, where you might have a private equity firm saying, okay, we'll invest $100 million. We'll buy shares at $10 each. And the public market investors like this because they've got this merger going on. They don't have inside information about what's going on. But the PIPE investor, if they're putting in $100 million, they're certainly going to do due diligence. And if a private equity investor says, yeah, we think it's worth $10 a share, even though we're agreeing to a lockup, that gives the public market investors a lot more confidence. They've gotten certification. So the sponsors frequently find that by bringing in a PIPE investor, it's got a pro and a con. The PIPE investor might negotiate tough. They might insist that the sponsor shares vest, which the sponsor doesn't like. But the PIPE investment might certify to public market investors that this is a good deal. Don't redeem. And it also gives the operating company another $100 million of cash, whether or not the public shareholders redeem. So lots of deals have PIPE investors at the time of a merger. In terms of the evolution of the SPAC market, this chart shows for the last 3 years how those sponsor warrants have evolved. The blue line is the fraction of a share that the warrant gives the investor. 1 share would be 100%, half a share would be 50%, a quarter of a share would be 25%. And what we see is that 3 years ago, the typical warrant was worth about 3/4 of a share. Now it's only worth about 1/3 of a share. So the warrants aren't as generous. There's not as much of a free lunch for those IPO investors. We also see the red line is the first day return. What happened the first 2 months of this year, lots of investors figure out, hey, these IPOs are a great investment. So instead of the stock going public at 10 and the units starting to trade at 10, the price started jumping, just like with a traditional operating company IPO. But when the SPAC sponsors found that they were able to easily find buyers, they said, well, why should we give them half a warrant if we can give them a warrant that gives them rights to just buy 1/4 of a share? And so the market changed where when investors said, we're really enthusiastic, the sponsor said, okay, we'll make you less enthusiastic. We'll make the deal terms less generous to you so that we and the operating company can keep more. So to conclude, a SPAC merger is, for almost all of the cases, a more expensive way for a company to go public than a traditional IPO. But we still see a lot of SPAC mergers occurring. We also see a lot of IPOs. So it's not as if we've got one size fits all, where one or the other is best for everybody. A SPAC merger might have some advantages over a traditional IPO, which appeals to some companies. It might be faster, it might be more certain. One thing practitioners sometimes mention is in the announcement of the merger, and the SEC forms for the merger that have to be filed. The operating company can make projections about the future. Whereas in a traditional IPO, they don't make forecasts for their future revenue or future earnings. And for a company that might be a startup electric vehicle company or a startup air taxi company, they might like to make those projections and find a SPAC merger more attractive. Historically, the IPO investors have gotten a great deal, an average annualized return of 12%. As I mentioned before, I don't think that's going to continue. I think it's going to fall because it's been a free lunch. The de-SPAC returns have been disappointing. That's not sustainable either. Something's got to give there. The merger terms have to be more attractive, or otherwise there's going to be more and more of a problem with finding pipe investors. If they can't sell until the stock price has dropped, why should they keep investing? And public market investors, if they're going to lose money on average, why should they not redeem? So I think those things are going to be changing, and the SPAC market continues to evolve. So why don't I end there? And I think we've got time for a couple of additional questions. Phil, are there some audience questions?
Yeah. Are SPAC mergers concentrated in particular sectors?
There have definitely been some industry patterns. I mentioned electric vehicle startups, air taxis. A number of these companies have zero revenue and have not had many traditional IPOs. On the other hand, there haven't been many biotech companies going public via a SPAC merger. They've mainly been doing traditional IPOs. But when we look at the median age of companies merging with a SPAC, or the median annual revenue, it's actually very similar to that of IPOs. So it's not as if we've just got the low quality firms doing SPAC mergers. And there's actually been quite a variety of industries and geographies represented. Some foreign companies do a SPAC in the US, or a foreign sponsor does a SPAC in the US, and then looks for a company in their home market as a way of taking it public in the US. Or some US SPACs are looking for a Latin American tech firm to merge with, or an Asian consumer goods company to merge with. So there have been a fair number of international deals as well.
Thank you. And I have one more at the moment, but if anybody else has a question, please just use the chat function. You talked about SPACs being mainly in the US to date. Do you see this changing in the years ahead? Do you see Europe or Asia having more SPACs going forward?
Yes, I think there's going to be an increase around the world. Some stock exchanges and governments are changing their regulatory requirements to allow a SPAC structure to occur. For instance, the UK, where this trading halt after a merger announcement causes a problem, my understanding is that there is a move to change that regulatory situation. But the boom in the SPAC market in the last 6 months or the last 9 months, I think is a once in a lifetime experience. I could see sustainably in the US 50 or 100 SPACs per year. Around the world, maybe a similar number in other countries, but I don't think they're going to replace IPOs. They're more expensive. I think they'll become less expensive as the SPAC sponsors agree to take a smaller piece of the pie. But SPACs have been around for a while. I expect they'll continue to be around, but I think they're going to coexist with IPOs, but they're definitely not going to be replacing IPOs across the board.
Thanks, Jay. We have a couple more questions. So do you think SPACs will become a backdoor for low quality firms for going public?
I think there is that danger. There's so many SPACs out there now looking for a merger partner that some of them are probably going to take lower quality firms as merger partners, but they're going to run into a problem. Hedge funds that own the shares pay attention. If they think this is a low quality firm where the deal terms just aren't very attractive, they're going to redeem. And it's going to be harder and harder to find a pipe investor that thinks we can salvage this if they wind up being the only investor because everybody else has redeemed. So that's one of the reasons why I think that even though historically only about 15% of SPACs have liquidated, I think it's going to be at least 1/3 of the current SPACs that are out there, maybe even 50%, that will never find a merger partner where investors are willing to agree to the deal. So there definitely will be some low quality companies attempting to go public with a SPAC merger. But I think some of the checks and balances that are there and the sophistication, the growing sophistication of some of the players is going to result in the market killing some of the deals. Just like a year or so ago, 2 years ago, WeWork, the office sharing company, attempted to go public at a really high valuation, and public market investors said, "No, you're not worth it. We're refusing to finance you." So I think the same thing will be occurring in the SPAC market, where the market isn't perfect, but people aren't looking for opportunities to lose money.
We have another question. Can retail investors access SPACs? If so, how? And more generally, what are the restrictions for investing in SPACs?
At the IPO, I bought a bunch of SPACs in the market after the IPO. But typically they go public at 10, they start trading at about 10. They don't jump to 12 or 15. So I bought some at $10.01, some at $9.99. And so they're easy, they're relatively easy. They trade just like any other stock once they've gone public, and it's easy for retail investors to buy them. Now, at the time of a merger, you do have to pay attention. You have to decide, do I want to redeem? Do I want to sell the shares? Because there is a danger. What if 99% of people who are paying attention redeem and you haven't, and then the stock price drops by a huge amount? You're going to suffer a loss there. So retail investors can participate easily, but you do have to pay attention. Of the SPACs I bought enough shares in each one of them to make it worth my while to pay attention.
Thank you. Any more questions from anybody else?
Okay, if we've got just a couple of minutes before the awards ceremony starts, I'd just like to tell you about my personal experience in investing. Last summer, this project started when two practitioners reached out to me and they said, we know you do a lot of work on IPOs. Would you be interested in getting our data on SPACs? And these were practitioners that had big data sets about SPACs. And I said, sure. And my doctoral student, Min Mo Gong, was enthusiastic about working on this. So we started working on it. And as I was talking with these practitioners, I realized, hey, there's a free lunch here. I should be buying some of these things as well. So last fall, I did start buying some SPACs. And in January and February, the prices went up, even though they were just sitting there with $10 in cash. Some of these that I had bought at like $10.01 had gone up to $11 or $12. And I was saying, this is great. There is a free lunch here. I'm a really smart investor. But then in March and April, the prices dropped back down to about $10.01 or $10.10. Right now, my average return with kind of a 6-month holding period has been about 1%. I'm not as smart an investor as I thought I was at the end of February. But on the other hand, I haven't lost money, and I don't expect to lose money.
Thanks, Jay. We have one more question. I think this will have to be the last one now. What do you think of the new SEC ruling that requires warrants issued to initial investors to be treated as a liability and not as equity?
The most common warrants that are out there are employee stock options. And in the US, about 20 years ago, the SEC said, these ought to be counted as compensation expenses and show up on the income statement. And you can make a pretty strong case that warrants purchased by a sponsor ought to be treated as an expense of the SPAC and therefore show up as negative on the earnings statement. So I can see that case. For many decades in the US, Silicon Valley and venture capitalists and Wall Street had argued, if you expense stock options, companies are going to report lower earnings and stock prices will fall and it will hurt the tech sector. And the whole venture capital community will collapse. Well, it didn't happen. Whether SPACs expense warrants or not, I don't think it's going to have any impact. It'll have an effect on the balance sheet, but it doesn't have any effect on cash flows. And investors already had figured out, hey, this warrant situation creates potential dilution, and we've got to take that into account in valuing the stock and the company. Whether it shows up on the accounting statements or not, I don't think it's going to have much effect.
Okay, Jay, thank you very much. And thank you for the insight on your own investments.